Good afternoon, everyone. This is Jim Busch at briefing.com. I'm a senior managing analyst here. I also manage the idea generation team, and that consists of, for the most part, emerging growth, next big thing, liquid momentum, and value leaders. And today what I'd like to talk about is basically just walk you through the emerging growth stocks system. And what we'll do is I'll give you a little bit of an overview of what the system, how it began, what it was designed to do, what it was not designed to do. I'll give you some insight into how the rankings are constructed. I'll talk a little bit about story stocks, and finally I'll go through some brief strategies for using the emerging growth stock system. And finally, at the end, hopefully we'll have some time for some Q&A. So emerging growth stocks, it was originally created in the fall of 2008 and launched in early January 2009. And it was created in order to uncover small, fast-growing companies that have the potential to become market leaders. It's made up of, for the most part, two parts. The first is purely quantitative. Those are the rankings themselves. Those are published and updated every Monday. And the second part of it consists of basically the analyst team here at Briefing. And we publish fundamental commentary and spot analysis on those ranked companies. If you're not familiar with emerging growth, or if you're new to the service, I'll just give you a quick idea of where it is and what it looks like. From the live and play page, if you just, the top navigation, if you pull down the investing and trading menu, emerging growth stocks is right at the top. So that'll take you right to the columns or the reports that we publish. So if you clicked through there, what you would be viewing is Monday's updated rankings. You'll see on that day we just had one new addition. If you were to scroll down that Monday column, you would come to the rankings table itself. And what you'll see here is that not only do we have the companies themselves, but we also provide some key data for each one. And I think the most important thing about the table here is one of the things that we try and do is make sure that readers understand these stories. So for every new addition to the top 25, our analyst team writes up a company description for each one. And it's not so much, here's what the company does, because you can find that anywhere. What we do is not only do we tell you what the company does, but we make an effort to describe the catalysts that are moving these stocks. Also, if they're part of sort of an investment theme that happens to be current. And really, that's what we're trying to do, is make sure that, since these stocks are showing up on the emerging growth stocks list, it means that they already have some relative strength, so they're already strong. And we want to make sure that readers understand why they're strong and whether that's sustainable or not. So this is just a screenshot of the live and play page. And just to give you an idea of some of the spot analysis we do periodically throughout the week, our fundamental analysts will do spot analysis or just fundamental commentary on individual emerging growth stock names. With this example here, Restoration Hardware reported a great quarter. Soon after the numbers came out, our analyst published some fairly detailed spot analysis about the quarter and his thoughts on whether they did what they needed to do and how the individual metrics came in. After the conference call, he posted a follow-up basically saying how the call went and kind of wrapping the whole thing up. So we do, especially during earnings season, we do pretty extensive coverage of some of these names. So that's what it looks like and where to find it. So basically now what I'd like to discuss is what emerging growth stocks was designed to do. It was specifically designed to be a quantitative idea generation system that flags new growth stock ideas every week, so every Monday. And that's regardless of market conditions. And it's narrowly focused on small to mid-cap companies with above average growth rates and high relative strength. So let me just back up a step because I think I'll give you an idea of why emerging growth stocks was created in the first place because I think it informs this slide. Back in the summer of 2008, it was a really, if you remember, the market peaked in late 2007, really started to grind lower in 2008. Some of the financials started blowing up, but it was really just a terrible investing market. You could tell the bear market was coming. Didn't necessarily know it was going to crash, but you knew that it was coming. And it was during the summer of 2008, in the very early fall, when, I mean, it was such a terrible market. It's the sort of market that you just get disgusted with. You probably, you know, I know myself, I started to get the idea, well, you know, I'm just going to stand on the sidelines. When it gets better, that's when I'll get back in. But what I was concerned about with my attitude there was, one thing about bear markets is you never know exactly when they're going to occur, and you never know how long they're going to last. But what you do know is that when the bottom comes, it's going to come very suddenly, and it's going to be a sharp move. And what I wanted to make sure was that even if the market continued to go lower, that I had a system in place that would force me to stay on top of basically the leading growth names. In a bear market, I probably wasn't going to buy them, but I wanted to make sure that at least once a week, I would have a list of stocks that represented the top growth names so that at least I would be familiar with them. So when I decided it was the right time to get back in, I would already know the leading names. And basically when we launched Emerging Growth in the first week of January 2009, I mean, the timing couldn't have been better. It did exactly what it was supposed to do. In February, a full month before the bottom, it was already showing Green Mountain Coffee, ArcSight, Pegasystems. You know, these are some of the first stocks that basically were unknown before then. And these were the first ones to break out when the market finally bottomed in March of 2009. So it did exactly what it was supposed to do. I was already familiar with Green Mountain Coffee, for example, before it even broke out. So that's what the emerging growth system is designed to do, is flag these ideas and keep them in front of you so that when you feel the time is right to get into them, you already know them. You're already familiar with them. So that's what it's designed to do. In terms of what it is not designed to do, it is not meant to be a portfolio investing system. So in other words, when we publish the updated rankings on Monday, it's not meant to be the sort of thing where you automatically buy the new additions and automatically sell the deletions. Simply not the way it's constructed. And also due to its narrow focus on small to mid-cap growth, it's not going to pick up the mega-cap growth stories like Apple or Google. There are no valuation components to the emerging growth scan. So it's not going to pick up value-based ideas. It's not going to pick up yield ideas. And finally, this last bullet point might surprise some people, but I think it's an important point to make. The quantitative ranking system is not designed to isolate quality ideas, and I'll explain that in a minute. But this is a key point with any ranking system or screening program. Quantitative systems cannot screen for quality, and the reason is because quality is a purely subjective thing. So what a screener or a ranking system does is you isolate those characteristics that you believe make up a winning stock. You know, for myself, with the emerging growth system, it would be various fundamental and technical indicators. Then you would use a screener or ranking system to create a short list of names that possess those attributes. And then it's up to the analyst or investor to determine the quality of each name produced in the list. So this is a very important point, and it took me actually. I've been running screens and putting together ranking systems for years now, and it took me a little while to figure this out. But you can fine-tune your screen or your ranking system as much as you want, but at the end of the day, you're always going to have sort of outliers there. You're going to have a mix of very high-quality names, and you're going to have a mix of low quality or speculative names, and a lot of the names are going to be kind of right there in the middle. So this is a point that I wanted to make. Having said that, this is the reason why we have an analyst team that also works on emerging growth, why it's not a purely quantitative system. So the rankings are quantitative, but we have analysts who look at each one as they're added, write them up, give their opinion on them, and what we try and do is communicate to people, which ones we think are quality names, which ones we think are either low quality or inherently speculative names. And this is why the human element is key here. So this is something that comes up all the time. I get emails saying, what do you think of company XYZ? It was just added to your rankings. And I may write back and say, well, to be perfectly honest, I'm not really a fan of it. And I might get a sort of a surprised reply back saying, well, what do you mean you don't like it? You just added it to your emerging growth rankings. And this, again, goes back to that point right there. You really have to use your sort of experience to determine the relative quality of each one. And we'll help you do that. So looking at the rankings themselves and sort of what goes into generating those rankings. First thing is market cap. In keeping with the emerging growth name, it's focused on small and mid-cap companies. We also, relative strength is a big component of this. We use 6-month relative strength. And the reason why I picked 6 months is because there are a bunch of academic studies out there, and industry studies as well, that basically, these studies show that relative strength is the single best indicator, or the best single indicator, rather, for predicting future price outperformance. If you're curious about reading up on these, Charles Kirkpatrick is an author I cite every now and then. O'Shaughnessy, What Works on Wall Street, that's a pretty well-known book that also shows these studies. So there's a reason why I use 6-month relative strength, because that's considered to be the optimum metric for that. Another note that I'd like to say about relative strength, because I get this question a lot, is that relative strength is very different from the relative strength index, or RSI indicator. And many of you might already be aware of the distinction, but for those who aren't, the relative strength that I use, and the traditional method as well, what it does is it looks at the price performance over, in this case, a 6-month period. And then it looks at every other stock in the all stocks universe and looks at their price performances. And then it sorts them, and and then I'll rank them on percentile. So the very strongest stocks in terms of price performance over that period will have a rank of 100, and the very weakest will have a rank of 1. So that's relative strength. It compares the stock's price performance versus every other stock out there. The RSI indicator, relative strength index, compares a stock's current price movement versus its own historical price movement. So if you take, say, a stock like Google, what the RSI indicator does is it compares the current price action versus its own historical price action over a given period. So very, very different, even though the names of these indicators sound almost identical. Relative strength actually could be its own webinar. There's so much that sort of goes into it and so many ways to interpret it, but I'll leave that to another time. So moving along, in terms of the rankings, so sales and EPS growth rates are the 2 growth metrics that we use. I focus on most recent quarter, and the reason why I only use most recent quarter is because for these small growth companies, generally they're just entering their, I don't want to say hyper-growth phase, but they're just kind of entering that big growth phase of theirs. And sales and EPS are just starting to accelerate, just starting to get very strong. And the prior fundamental data just simply isn't as relevant. So if you look at the year-ago EPS growth or the 3-year average EPS growth, those are relevant for big cap companies that are established and then kind of hit their steady state in terms of their growth rates, but for young companies, they're really not. So what I'm trying to capture is just the most recent quarter because I think that captures sort of the turns with these smaller companies better. Moving along, I also require profitability for the emerging growth stock screen. Margin expansion is not a requirement, but it's in there, and companies who are experiencing margin expansion, that will help them in the rankings. Low debt levels is another thing that we require. We actually have a hard cap on the long-term debt to capital ratio. So for any company that has more than a moderate amount of debt, we exclude them. And that's for obvious reasons. Small companies that are just entering their growth phase, if they're burdened with a lot of debt, that's not something, at least, that I'm interested in. Oh, and by the way, I just want to tell you too is, if you have any questions, feel free to put them into the chat at any time, and I'll get to them in the Q&A. So don't wait for me to get to the Q&A before you submit your questions. You can just enter them in anytime you want. Okay, so those are the primary inputs for the ranking system that I just went through. Once those and a few others are screened, it narrows down the all stocks universe from about 3,500 U.S. stocks down to 75 to 200, really depending on market conditions. And then that remaining short list is sorted by relative strength rank from highest to lowest. And then there's a secondary sort incorporating fundamental criteria. So that's how the rankings are going to appear. When you look at the rankings table on Monday, you'll notice that the number 1 ranked stock has the highest relative strength, and it flows down from there in descending order. So looking at the table itself, the buy list consists of the top 25 stocks, and these are the ones that we write the descriptions for every week. And those are the ones that we consider, and when a new addition is added to the top 25, that's when we write it up. This is also when we first start tracking its price performance, when it makes its first appearance in the top 25. And we'll track price performance as long as it remains ranked within 1 to 100. So it can fluctuate anywhere from 1 to 100, and we're still tracking it. Once it falls off the list, it's considered deleted or sold. And the hold list, which is ranks 26 through 100, that consists of both tracked stocks and untracked ones. The reason why we include the untracked stocks in that lower section is because it actually makes for a really good reference. I mean, oftentimes what you'll see is that, all the stocks that appear on here meet sort of our minimum growth criteria. So they show the good growth rates and fundamental characteristics that we're looking for, but their placement on the list is determined for the most part by the relative strength. So you might see some stocks sort of hovering between 30 and 80, and they may have a relative strength rank at 85 or even 90, but they're not quite strong enough to get pushed up into that top 25 area. So it's good to become familiar with those in the holds list the longer they stay on there, because there's a pretty good chance that at some point, they might report a really strong quarter, and that'll be enough to kind of push them up finally into the top 25 ranks. So that's how our ranking system works, and that's how we track price performance. So that's sort of the mechanics of it right there. Now, in terms of how you interpret these names and analyze these names, one question that I've gotten consistently over the years is, there are a lot of stocks on the emerging growth list. How do I pick out the best ones out of that list? And from my perspective, when you're looking for investment ideas among the emerging growth stocks, the ultimate goal should be to uncover story stocks. And that's sort of an ambiguous term, I know. But basically, you're looking for stocks that have sort of a unique combination of fundamental catalysts. And as I mentioned before, we help you try and find these and narrow down the list of these story stocks by providing not only the descriptions when they're added to the top 25, but also with the spot analysis that we'll do periodically throughout the week, especially during earnings season. We really try and highlight those that we think have really unique stories. But again, the whole idea of a story stock can be kind of ambiguous. So here is sort of my informal checklist of what makes for a good story stock. The very first one is a new or disruptive product, technology, or concept. I have concept in there because for a retailer, they don't necessarily have a new product or technology, but they may have a really innovative concept. With the second bullet point, fast sales growth, this really should be the mirror image of the first one. In other words, if this company has a truly innovative or disruptive product and it's really starting to be accepted into the marketplace, this should be reflected in fast sales growth rates. So I see it as you really shouldn't have one without the other. I find, too, that companies that have a very narrow focus tend to be the best ones. And to give an example of that, if you listen to a lot of conference calls, especially technology conference calls, you'll always hear these, say, these small networking companies who have their niche. They have a niche market focus. They have maybe one product or just a single product line. And you'll always hear them say that they're taking share from Cisco. You hear this all the time during earnings season. And it's not just Cisco, but it's these other big technology companies like Cisco or IBM or Hewlett-Packard. And it's because the big companies, I mean, in some ways they're legacy. Their company is several generations behind Earth legacy, but they're really just aggregators at this point. And these smaller companies are much more nimble. They're focused on just one thing, and you'll almost always hear them saying they're taking share, from these larger companies. And that goes to the next bullet point. That's something to specifically listen for during the conference call. And oftentimes companies will also sort of break out what they think their market opportunity is, total addressable market, or TAM. They might say they have a TAM of, say, $5 billion, $5 billion market opportunity. And if they also give you an insight into the penetration, that helps you much more. They might say, well, we're only 5% or 10% penetrated in this very large market. So that's always a big positive right there, especially when they say they're underpenetrated at, say, 5 or 10% or even 15%. It means they have a long, it implies there could be a multi-year growth story there. And finally, I look for the potential for operating margin expansion. And I put the word potential in there because with these smaller growth companies, it's always nice to see actual margin expansion occurring right now. That's always great to see. But with so many of these smaller companies, once their growth really starts to ramp up, I mean, they're really focused on the top line. So what they're trying to do is basically capture as much of the market as they can while the opportunity is still hot. And this fast revenue growth that they're experiencing, they're really sort of pouring that into building out their sales force, their marketing, and their R&D. And that has the impact of sort of tamping down their operating margins. So this isn't a negative. It might even lead to small losses with some of the names. They might be putting up 50% revenue growth every quarter, but they might be reporting, a penny per share in profit or a loss of 2 cents. That's not a bad thing because this is a planned sort of suppression of their operating margin while they build out their sales force. So I don't see that as a negative, and it actually works out to be a long-term positive in many cases because, one real catalyst is in terms of, beating expectations. Operating margin expansion is always helps in terms of putting up a nice beat, right? So once these companies have built out their sales forces and their marketing departments to the point where they feel like they have adequate coverage for their territories or for their market, that's when that leverage, that earnings leverage really starts to kick in, and that operating margin starts to expand, and that's when they turn in these really big beats. So that's something to keep in mind for as well. Don't take it as a negative if operating margins seem low, if there's a credible explanation for it. So that's my informal checklist. I know some of you might be wondering, well, which current emerging growth stocks sort of qualify here. So I gave you a short list. These are just my personal selections of what I consider really good story stocks from the emerging growth list. Infoblox and Pros are probably my favorite. Splunk and Imperva, you're not going to see on the list right now. They had been on there for a while, but they got removed recently because they reported a small loss, and again, building out their sales forces. So I don't see it as a negative because the revenue growth is great. PowerSecure, Ambarella, Cree, WageWorks, these are all good names. We've been commenting on a lot of these recently, so if you're curious about any of them, you can always look in the archive. You can search under my ticker, which is SETUPX, or you can search under the GrowX ticker, or even just the company ticker, but you're probably going to find a lot of stuff under the company ticker that isn't analyst commentary, could be news. So there's a lot of information already in there on these names, but again, this isn't a buy list. This is just, these are names that I think fit the bill, when it comes to, what's a good story stock on emerging growth, or which has recently been on emerging growth. So, in terms of general strategies for how to use the emerging growth list, I think this top sentence is pretty key. In the majority of cases, when a stock is first added to the top 25, it almost always looks technically extended. And that makes sense because the top 25 generally consists of the very top tier in terms of relative strength. It's usually 95 or above. And what happens is a stock may have been rising before, or it may have been consolidating near the highs, and then typically there's some kind of event, typically an earnings report, better than expected earnings report, that really lights a fire under the stock, and it jumps 20%, and that's the type of events-driven catalyst that will push that relative strength rank up into that top segment. But when it hits the list, it's going to look very extended. So two strategies to manage this dynamic are as follows. And they're both, it's not rocket science, but I think they make sense. So the first one is buy a partial position now once you've identified a real high conviction idea, say 1/3 size, just to get sort of some skin in the game. And then buy the remainder when the stock pulls back or settles down into a consolidation pattern. The other option would be to simply buy on a pullback. So again, once you've identified a high conviction idea, just determine a technical entry zone and wait patiently for it to hit it. The problem with the buy on a pullback strategy, I mean, it's not a problem, but just the reality with the buy on a pullback strategy is that these are high relative strength stocks. They have a lot of momentum. So they may not pull back substantially. Again, they tend to be catalyst driven. A great earnings report sends, all of a sudden you have this big wave of accumulation. So it might just have minor pullbacks at first. So, for example, if you say, well, I'll buy it if it pulls back to the 20-day, or I'll buy it if it pulls back to the 50-day. With some of these names, you might have to wait for months before that happens. And since those moving averages are also rising with the stock price, it could be at a higher price than where it was when you originally found out. And this is why I personally prefer that first strategy, which is once you've identified a high conviction idea, a story that you really like and you want to own, buy a partial position right then, again, say 1/3 size. And then if it goes up, at least you're participating in it if it continues to go up. And if it pulls back, you're happy because that allows you to buy the remainder of your position. So it really is sort of a very practical way to play these high relative strength ideas, at least the most practical that I've seen. So in terms of technical strategies, basically what I'll say is that I always look at the weekly chart first, sometimes the monthly, but for the most part the weekly chart first to get kind of the big picture view of what the stock's been doing, and then I'll zoom in on the daily. So for early stage ideas, in other words, you're trying to find stocks that look like they're early in their advance, I focus on stocks whose weekly charts have carved out sort of a broadly sideways range. And what I mean by that is, for example, let's say a company had their IPO a year ago, or 2 or 3 years ago, and for one reason or another, it's basically established a range and traded in a range since then. Maybe it had an initial run and then pulled back, and then it's just sort of been moving in, say, a wide range between $20 and $40 for 2 to 3 years. I love those charts because even though they may continue in that range, that's certainly a possibility, if they're showing up in emerging growth, what it probably means is that they're starting to bump up at the upper end of that, that range, that trading range, or they just broke out from that multi-year range. And when you see a stock break out from a multi-year trading range, that could be a home run type of stock right there, because I mean that's a long-term base that it's been establishing for several years, and that could turn into easily a multi-month or a run that lasts a year or more. So they're not very common, but you certainly do see them. So always be on the lookout for those, and I'll give you an example of one of those. I'd say be wary of stocks that have already been running for several years straight, or have already risen in a parabolic fashion. And finally, avoid charts that are just noisy and erratic. And so I'll give you an example of each of these. So for example, the early stage one. This is Imperva. This is actually a chart that I used in a presentation from about a month ago. But it illustrates the chart pattern that I'm talking about. It's still pretty much relevant. They had their IPO in late 2011, and they basically established that range, actually the $20 to $40 range that I was referring to. And they basically traded sideways for almost 2 years, just sort of carving out that range. And then it started to bump up and consolidate right under those highs near 40. To me, that is a super bullish pattern on a weekly chart. Imperva actually just started to break out from that. It's not terribly extended right now. But to me, whenever you see a pattern like this, you really want to look, you want to dig deeper into that one and make sure you know it. As for sort of a bullish daily pattern, this is one that was just recently added to emerging growth, I think maybe 2 weeks ago, maybe 3 weeks ago. It's called Park City Group. This is a really small software company. I think it's a microcap. And it was started by the founder of Mrs. Fields Cookies. And after he sold that company, eventually he started up a software company. So they basically make supply chain software for grocers and drugstores. It's not sort of a pristine story. I mean, it's actually pretty hard to find information on this company. So there's still some questions. It's very speculative, I'll put it that way. And I think we made that clear in our write-up on it. But when you see a pattern like this, especially in sort of a thinly traded microcap that has good growth characteristics like this one does, that's a very bullish pattern. And Park City, this is what it looked like on the day it was added to emerging growth. It's since broken out, and it's quite a bit, might be 20% above that level now. It's trading at new highs. But this is the type of daily pattern, especially for a single-digit stock that you're pretty confident no one else has heard of. It's kind of the daily pattern that shows a nice level of accumulation, kind of quiet accumulation. So be on the lookout for these. With Park City, again, that's a speculative one, so I would definitely do your due diligence on that one. But the chart is a good representation of what I'm talking about. Here's an example of basically a mature uptrend. This is NetSuite on a weekly chart. And basically, I really like NetSuite. It's a great story. I mean, the company has executed almost flawlessly, and that's reflected in the stock. You can see that on a weekly chart, the price starts off in the very lower left corner, ends in the very upper right corner, and that's a picture-perfect uptrend, nice steady uptrend. But when you look at this, you really can't say, okay, that's a new idea. This has been under accumulation for years. So this is a mature uptrend in my mind. I really like the NetSuite story. I think it's a great company. But at a certain point after a multi-year run, the stock's going to take a breather. And that breather could last 6 months to a year, given how long this has been running. That would just be a normal consolidation for it. And I don't necessarily want to be buying in front of that. So this is where, even though it's a great uptrend pattern, think of it in terms of the weekly chart again as, ask yourself, is this uptrend fairly mature? And, like I said, I don't necessarily avoid these, but I appreciate sort of the risk in them. Here's an example of a parabolic rise, again, a weekly chart. This is Santerra. This has been one of the best performing stocks on our emerging growth list in the last year. I think it's up about 100 and some odd, 150%, 170%, I can't remember. But as you can see, as I've drawn those trend lines on the weekly chart, you can see that each one has gotten steeper. And that's really sort of the definition of a parabolic rise. With Santerra, I like the story. It's actually a really good story. It's a pharma company. They having a lot of positive news flow. For a while there, it had a pretty reasonable valuation. It's just been a nice steady mover. But again, this stock is going to take a breather at some point. It's going to consolidate those gains at some point. And I have to ask myself, do I want to buy ahead of that? As that stock keeps going higher in a parabolic fashion, that increases the risk that the consolidation is going to come, and I don't want to be buying in front of that, even though I like the story. This is that last one where I was referring to noisy or erratic patterns. This is Quanstar on a weekly chart. And to me, this is just a total mess. If any of you can identify a chart pattern in here, you're a better analyst than I am, because this is pure noise on my part. Even if I came across Quanstar, and let's just say they reported a great quarter, was stronger than expected, they have a new product cycle, whatever the case may be. When you look at this chart, the odds are really high that you're going to get blindsided within, maybe the next quarter or maybe the quarter after that. It's just the nature of this one. Whenever it goes on a big run, it almost always gets slammed down hard. And this is the type of chart that, like I said, I may even like the fundamental story, but as soon as I see a weekly chart that looks like this, I just run away from it. I don't even consider it, because just the character of the stock is just too random and too risky for me. So that's the sort of the formal part of the presentation. If you could just give me a moment here to quickly review the questions, we'll start the Q&A. Well, first of all, there will be a replay after this, by the way. We'll post the link. Another listener asked, is there a leading short list? Sort of, I guess, the inverse of the emerging growth list, stocks that are overpriced. The answer to that is no, we don't publish short lists. First of all, high relative strength stocks I would say, don't lend themselves to short lists, and they just don't lend themselves to sort of the list format. You really need to know a high relative strength stock well in order to determine when it's topping out. And in my mind, it's a much more subjective exercise than sort of what we have now, which is sort of the long version of the emerging growth list. Okay. And someone actually did request that I do a webinar about relative strength in the future. I can certainly start working on that. I think it'll actually be an interesting one. There's a lot to say about that. Someone asked what distinguishes our system from O'Neill's CanSlim system. That's actually a good question. If you look at the components on our rankings versus what's on the IBD 50, you'll see it's actually a very different list. We have, I mean, CanSlim is a great system, and the IBD 50 I know is widely followed. But for one reason or another, that system didn't work for me, which is why I created emerging growth. And I keep the emerging growth system focused very much on what I call current and forward-looking indicators. Current meaning just the most recent quarter, fundamental data. Again, I think that's much more relevant for small growth stocks than it is, the larger ones like the Apples and Googles. You can look at, say, the 1-year EPS growth or the 3-year EPS growth, but I just don't think, my focus is on the smaller names. So that's one of the big differences. And we just have different, I use a different relative strength calculation than CanSlim does. I know that. I use a different time period. They use a 12-month system. I use a 6-month system. So it's just a different list. I mean, I personally think they're both good. But the focus of emerging growth is on the smaller names and the more current data. Okay, someone actually asked for just a quick word on how I calculate relative strength. Sure. As I noted before, first of all, relative strength is completely different from RSI, relative strength index. They're two completely different indicators. The way I calculate relative strength is, well, first of all, the traditional way of calculating relative strength is to just take, if you're doing 6 months, you just look at the price performance from the price 6 months ago versus the price today. So it's just a straight percentage calculation. The reason why I don't use that is because, well, the current price, obviously that's fluctuating. For high relative strength, it's probably going up. That's fine. But the problem is that in the traditional calculation, the 6 months ago price is also fluctuating. So you often have these situations. I mean, it's not uncommon to have a situation where the current price is rising strongly, but if by coincidence the price 6 months ago also happened to be rising, it's going to create a funny relative strength number. It's going to basically tell you that there's no real progress. The stock had basically been sort of flattish, I guess you could say. So what I use is a different calculation that sort of removes that side of it. What I use is obviously the current price. And then what I compare it to is the 6-month moving average. And this is actually the same calculation that's used in those statistical studies I mentioned earlier. And the reason why I much prefer that is because it removes any sort of volatility in the denominator. So in other words, it's tracking how the current price is doing, which is what you want, but it really smooths out what the comparison number is, since it's a 6-month moving average. So it's not, the 6-month moving average really doesn't fluctuate much from week to week, which is exactly what I want. So I think it's a superior method from the traditional way of doing it. Someone asked, where can I find more information on your system? What's the website name? You can simply go to briefing.com, www.briefing.com. And the emerging growth system is found on the Briefing In Play Plus product and any of the products that are above that. So that's where you can find that. You can sign up for a free trial there if you're interested in taking a closer look at it. Someone wrote in and just noted that with blocks, which I had noted is one of my favorite story stocks, the PE is very high. Is it still sort of viable? I'm not going to answer the question as to whether it's still a buy, but keep in mind too that this is, with blocks and with many of these other kind of young growth stories, I don't focus as much on the PE. And the reason for that is sort of what I described before. So many of these companies are plowing all of their revenue into building out their sales force, building out their marketing, building out their R&D capabilities and that sort of thing. So they're intentionally sort of depressing their operating earnings while they expand their sales force and marketing capabilities. So that's going to result in high PEs. What I prefer to look at is the price to sales ratio. So, and specifically the forward price to sales ratio. So, for companies now, I prefer to look at the estimates for the next 12 months, but you could look at the fiscal 14 sales estimate and calculate a price to sales ratio. And that's what I consider more relevant because, again, these are top line stories. So if you have a company that, like Power Secure, for example, when they were added to emerging growth in December, they had a price to sales ratio of 0.5. That's anything less than 1 is considered to be pretty darn cheap. But at the time, their PE, if I remember correctly, was sort of 20 or somewhere in that neighborhood. So people might just look at the PE and say, well, for a company like that, that's kind of pricey, not so interested. But you look at the price to sales, and again, this is a sales growth story. It was really cheap. And when you look at some of these other companies, they're not terribly expensive either when you look at the price to sales. And I would say that they'll turn into PE stories down the line once they get that earnings leverage and they kind of get to their peak margins and that sort of thing. But I think price to sales is more relevant, at least for me. Someone asked if I could repeat the website name. It's just briefing.com. So that's our company name. You can see it at the bottom of the slide there in the lower left. It's just www.briefing.com, and that's where you can find information on emerging growth and take a trial if you'd like. We have a few more questions about relative strength, and tell you what, I'll start putting together another webinar on that because it seems like there are quite a few questions about that, and it is a key part of the emerging growth stock system. So I'll just say stay tuned on that, and I'll put something together for those of you who are interested in that. And that's for the most part, those are the questions. If you have any further questions, feel free to submit them now, and I'll answer them. If we don't have any more, what you can do is the email address there on the bottom. You can always send me a question at emerginggrowth@briefing.com. That goes to me as well as a few other people. I'd be happy to answer that for you, any questions you might have. That'll do it. That'll do it. So again, please feel free if any questions occur to you after this is over, just send them to that email address. And one person's asking, where is the top 25 for the emerging growth list? Well, first of all, if you have Briefing In Play Plus or above, you would find it. You basically go to the investing and trading menu at the top menu there, and you'll see emerging growth, and then just pull up the most recent column that says rankings for the week of, and that'll give you the most updated Monday rankings. Like I said, it's always published on Monday unless there's a holiday. So if you still can't find it, shoot me an email, and I'll just send you a direct link to it. Someone asked, what system am I using for screening? we use FactSet for that, but there are other things that go into it as well. But that's our primary data source. We disclose that at the bottom of the table too, by the way, if you're curious. And I think that'll do it for today. So thank you all for listening in, and have a great night. And like I said, feel free to send me any questions if you have them. Send them to the email address at the bottom of the screen. Thank you.